represent the investor relations of Fermenta Biotech Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings conference call for the second quarter and half year ended of financial year 2021. Before we begin, I would like to mention a short cautionary statement. Some of the statements made in today's con call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. I would now like to introduce you to the management participating with us in today's earnings call. We have with us Mr. Satish Verma, Executive Director, and Mr. Sumesh Gandhi, Chief Financial Officer. I now request Mr. Satish Verma to give his opening remarks. Thank you, and over to you, sir.
Thank you, Anuj. Good morning, everybody. It's a pleasure to welcome you all to the earnings conference call to discuss our second quarter results for the financial year 2021. Being that this is our first earnings con call, let me start by giving you a short background about Fermenta Biotech Limited, and then we will move on to the financial and operational highlights for the quarter. As you may already be aware, Fermenta Biotech Limited was founded way back in 1951 by Dr. D.V. Raju, a technocrat, who was considered one of the pioneers of the Indian pharmaceutical industry. Initially, the company, then known as International Franchises Limited, was contract manufacturing formulations for the pharmaceutical industry. In the early 60s, Dr. Raju entered into a joint venture with Philips Dufar, a Dutch pharmaceutical company. Philips Dufar, incidentally, was the first company in the world to commercially manufacture vitamin D. This JV propelled the company into a full-fledged pharmaceutical company with its own formulations and brands. By the late 60s, with the help of Philips Dufar, the company also started manufacturing vitamin D API for the domestic market. That is only India. In 1976, the company's name was changed to Dufar Interfran Limited and was listed on the Bombay Stock Exchange. In 1980, Philips Dufar, our JV partners, was taken over by Solvay, and Solvay became our JV partners since then. While the company continued to manufacture vitamin D, limited, of course, to the domestic market, it flourished as a leader in the formulation business and built brands like Crocin, Lactocalamine, etc. In the early 2000s, the formulations business was demerged into a separate entity, and the foreign partners took majority control of this, while the Indian promoters took the majority of the remainder of the business, which was predominantly vitamin D API manufacturing. After the demerger, the company was renamed DIL Limited. DIL at that time also had a 35% stake in Fermenta Biotech Limited, which, that is, Fermenta Biotech Limited was established in 1986 with its facilities in Kullu, Himachal Pradesh, for manufacturing of PGA enzymes used in the manufacturing of antibiotics like amoxicillin, ampicillin, etc. Post the demerger, the promoters decided to consolidate all the manufacturing business under one entity. By 2003, DIL took over majority control of Fermenta Biotech Limited and transferred the API manufacturing to Fermenta. Until 2008-2009, the sales were restricted within domestic markets. However, in 2008-09, we entered the export markets. Since then, it has been an exciting journey. Over the last 10 years, we have grown from strength to strength, and now we supply vitamin D3 across the globe to more than 50 countries. And our overall revenues have grown from rupees 40 crores in FY10 to 400 crores at the peak in FY19, with almost 75% of our revenue coming from exports. Today, we are among the largest vitamin D3 manufacturers in the world. Looking at the growth potential for Fermenta Biotech Limited and thereby the need for investments into manufacturing capabilities and capacities, it was decided to merge Fermenta Biotech Limited with DIL to give it better leverage by combining the rich asset base of DIL with the strong revenues of Fermenta Biotech. This process was completed in FY20 and DIL's name was changed to Fermenta Biotech Limited. Now moving on to the quarter under review. Due to the ongoing COVID-19 pandemic, there has been a lot of research published linking the positive benefits of vitamin D for boosting the human immune system and helping in the prevention of the spread of this disease, which has had a positive impact on the demand and consequently on our volumes of human vitamin D3. However, the volumes and prices of animal vitamin D3 continue to be under pressure because of the overall market situation in the meat industry. Our human side sales volume for the quarter have grown by 26% on a quarter-on-quarter basis and about 77% on a year-on-year basis. Additionally, I am also happy to announce that company has completed its backward integration project at Dahej, Gujarat, and has started manufacturing its key raw material cholesterol. The plant has been capitalized in Q2FY21. Lastly, I would also like to mention in FY20 that the company had given ICDs aggregating to rupees 21 crores in various tranches to a non-related party for the development of a new product that was cholesterol from fish oil. As of date, the total ICD outstanding has been reduced to approximately rupees 12 crores. We have also received interest on this ICD of about rupees 1.6 crores till date. Now I will request my colleague Mr. Sumesh Gandhi, our CFO, to give the financial highlights for the quarter and half year ended. Thank you. Over to you, Sumesh.
Thank you, Satish. Good morning, everybody. On a consolidated basis in Q2 FY21, the revenue from operations for the quarter was at rupees 93 crores, which was an increase of approximately 15.6% on a year-on-year basis. EBITDA reported was rupees 27 crores, which was an increase of about 72.4% on a year-on-year basis. EBITDA margins stood at 28.8% as against 19.31% a year ago. Net profit after tax reported was rupees 15 crores, which was a decrease of about 55% on a year-on-year basis, while PAT margins stood at 15.74% as against 40.47% a year ago. However, Q2 FY20 PAT had a one-time deferred tax asset or a current tax benefit of rupees 20 crores due to the amalgamation of the companies, which is why the PAT for that quarter was higher and hence it cannot be comparable with this year's PAT. Talking about the half-year performance in FY21 on a consolidated basis, the operating income for the quarter was rupees 188 crores, which was an increase of approximately 15.9% on a year-on-year basis. EBITDA reported was rupees 49 crores, which was an increase of about 22.9% on a year-on-year basis. Operating EBITDA margins stood at 26.25% as against 24.75% a year ago. Net profit after tax reported was rupees 28 crores, which was a decrease of about 39.4% on a year-on-year basis, while PAT margins stood at 15.07% as against 28.83% a year ago. Again, this was due to the one-time deferred tax asset or the current tax benefit of rupees 20 crores, which I had explained earlier, so hence it is not comparable. Thank you, everybody. With this, we can now open the floor to the question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. The first question is from the line of Viraj Mahadevia, an individual investor. Please go ahead.
Hi, Mr. Verma, Mr. Gandhi. Congratulations on stable results. Couple of questions from my end. The 28.8% EBITDA margins we've done in the second quarter are meaningfully higher than the 19% last year and the 24% in Q1. Is that largely because of the backward integration and higher gross margins?
Satish, would you like to?
Sumesh, can you please?
I'll take it over. Yeah. So this is basically, Mr. Viraj, thank you for this question. However, this is not due to the backward integration which is there. We have had higher volumes as we spoke earlier on the human side. Plus, there has been an increase which we have seen on the human side and prices, the cost of which we have seen in higher EBITDA margin. So it is the backward integration has still not been factored into this.
Understood. So in that case, that's helpful, and that's what I suspected. Human volume should be better in price and volume despite animal being down. But given then in that case, Q3 onwards, we expect the backward integration gross margin uplift to kick in, and how much margin expansion can we expect?
If I may.
Yes, sir.
Thank you, Viraj. Viraj, backward integration should start kicking in from Q3, as you have said.
Right.
Margin expansion on an overall perspective, because vitamin D3 we sell in various formats at various to various countries and various customers. So it will be difficult to peg against a particular product format to which the margins will be impacted.
Overall, can we say 100, 200 bits at least?
I would rather say that our key raw material purchase is cholesterol.
Right.
We should definitely get about 20-25% minimum benefit on our overall purchasing that we do.
20 to 25%. And how much is raw material as a percent of sales? I mean, we can just work it out that way, right?
Yes. Sumesh?
Cholesterol purchase is approximately 45% of my total raw material cost.
So if we get a 20-25% benefit, 45% can come down to 35%?
Should.
Sure.
So technically your EBITDA margin, and that will all flow down to EBITDA. So EBITDA margin will go from 29% to very conservatively north of 35%. Am I seeing this correctly?
Yes, Viraj, to a large extent, yes.
Okay, good. Thank you. My next question is regarding, obviously, Mr. Verma, we live in a very uncertain environment, as we all know. Now, while the company has built deep capabilities in a single product, at the end of the day, it's still a single product risk, right? But you have capabilities in fermentation, from what I understand.
Yes.
Given the name of the company as well.
Yes.
Have you considered the PLI scheme of the government for fermentation products, in particular vitamin B1, being one of the products in the PLI scheme, which is fermentation based?
We did look at the opportunities in this scheme, but the scale at which you need to invest fermentation capabilities, it is too large. And the support that is required will be much more in terms of import restrictions to subsidies to everything. I doubt whether any company has jumped into the fermentation part of it yet, because we do have the capabilities, as you said, Viraj. But the fermentation capacities that need to be installed for these molecules that we are talking about. Even in antibiotics also, PGA-based antibiotics also, government was encouraging on fermentation-based in the PLI scheme. But the investments required are too huge for a company the size of.
Fermentation side, sir, I thought the investments were smaller.
No.
And I'm not saying we should do antibiotics, but how about vitamin B1, which is still ancillary to our sort of broader vitamin play? And the government is giving a huge subsidy back. So my understanding is actually within 3-4 years, your entire capacities are free.
We have looked at it. Even for B1 also, the capacities required are, the investments required are quite large. The investment. We are looking at, of course, fermentation. We have some products that we manufacture through fermentation in our Kullu plant. We have restricted capacities, I should say, compared to people have reactors the size of 1 lakh liters and all that. Our maximum size is about 8,000 liters that we have in Kullu. It requires a greenfield expansion for us. And we have a lot on the plate currently that we are looking at the nutrition side. So we decided after seeing all these things from an investment perspective, we decided to concentrate and focus on the nutrition side.
Understood. Appreciate it. That at least you all have given it consideration.
Yes.
And my last question, Mr. Varma, is regarding, sort of the non-core land bank that we referred to in our prior investment presentations.
Yes.
Obviously from a shareholder point of view, that depresses return ratios, ROCEs, it's non-core, it's idle sort of assets sitting on the books.
Yes.
Has there been any progress or intention to monetize or engage in discussions? Because that will first obviously pay off the debt that we have and then obviously fund us very nicely for our future expansion as well.
You are right on all points, Viraj. We are in the market. We are engaging with different parties, both through consultants as well as directly with potential real estate players. We still don't have anything concrete or even something that has started at a due diligence process also yet. But we are in the market. The intention is very clear. You asked about the intent. The intent is very clear that we would like to monetize it. We're just waiting for the right opportunity, nothing more.
Okay, excellent. All the very best. Keen follow of your progress. That's it from my side.
Thank you so much, Viraj.
Thank you, Viraj.
Thank you. The next question is from the line of Ketan Shah from Capgrow Capital. Please go ahead.
Good morning, sir.
Good morning, Ketan.
Hi. Sir, my question is on the European client. Can you update us on the progress? What is happening now?
Yes, the European plant is currently contract manufacturing vitamin D3 feed grade from in Germany itself through another company, a toll manufacturer. We have started minimal sales from there. Currently, our product is going through a testing, and it's a new format of the feed grade powder that we have. So it's undergoing tests and trials. We have sampled quite a few large customers, so they are testing and validating and our product. They have to use it in their formulations and wait for stability studies, etc. So currently, it's under that process. We're just waiting for that to be completed so that we can start serious sales from there. However, COVID and depression in the animal feed industry is not really helping on that front.
Okay. And sir, can you share some data on your client concentration now, especially on the export front? Is it well diversified or how is it?
Sure. Sumesh, if you can maybe give some numbers on this.
Sure. So, Ketan, we have approximately 300 plus customers which are there across the globe. And if we have to put across the concentration of it, approximately 11% of my revenue comes from USA, 34% comes from Europe, and approximately 27% will be from the rest of the world. I'm talking purely from a vitamin D3 and API point of view and nothing else. So this is how the whole concentration as far as the world is concerned. From a client perspective, it will be difficult for me to put across and tell you as to which all clients are there from a competitive perspective.
Okay, so let's say top 5 clients will be how much? Can you share that, or it's not possible?
Sure. So the top five clients would approximately be there for say 25% of my total revenue.
Okay. And sir, now what will be the CapEx going forward for, let's say, next 2-3 years?
Satish?
If all goes well, over the next 2-3 years, we are looking at investing close to 150 to 200 crores for all our new projects. We have taken a land in Kaika, which is in Gujarat, next to Bharuch. It's close to our Dahej plant itself, but this is not an SEZ. We have taken it as a greenfield project. So hopefully, if all goes well, maybe by next year, we will start the first round of investments.
Right. And this will be for diversification in new areas, right?
Mainly.
You mentioned in the annual report.
Mainly, yes. Of course, sticking to the nutrition portfolio, of course.
Yes. And funding of this CapEx will be through internal accruals?
It will be a combination of both internal and some part of the debt. Unless and until something works out on the real estate, then maybe we don't need to go for any external debt.
Okay. And can you share how much was animal feed as a percentage of volume for us, and how much was human?
Sumesh?
From a volume perspective, Ketan, it is very difficult because both the volumes are pretty different in both of it. However, from a revenue perspective in Q2, 69% of my revenue in vitamin D3 came from human and 31% came from animal. And if it is on a half-yearly basis, if we speak about, then 56% is from human and 44% is from animal.
54% animal. 1 minute. Okay. Thanks a lot, sir. I will get back to the queue. Thank you, sir.
Thank you.
Thank you. We would request the participants to please limit your questions to 2 per participant. The next question is from the line of Shikha Mehta from Equitree Capital. Please go ahead.
Hello, sir. I was just wondering, this raw material capacity that we've set up at Dahej, is that enough for our total requirement, or would we still need to procure some amount of raw materials from outside?
At full capacity production, it should satisfy our internal own consumption, captive consumption demand. But currently, we still continue to procure from outside until we are completely running at 100% thing for maybe 2-3 quarters at least.
Okay, so maybe in the next 2-3 quarters, we'd be at 100%, and then we wouldn't need to procure from outside.
We wouldn't need to procure from outside then, yes.
All right. And also, you've been talking about getting into other vitamins and other product segments. Is there any clarity on that yet, or which other vitamins or which other products you'll be looking at?
See, as we were always mentioning, it will be a combination of doing something on our own as well as finding strategic partners. So, for example, we partnered with 2 companies in South America for getting their astaxanthin, and one company we are getting their omega fatty acids and started marketing in India. We've already launched them. The market is at a very nascent stage. So, that we have already launched. We are completing a new building in our Dahej, for which we have spoken about the capex we are incurring. There, I think most probably once it is ready, maybe by the end of this financial year, we are looking at manufacturing vitamin K1 as well there. Similarly, we are working and engaging with other potential partners to bring other products. As far as our own products, which are minerals and other premixes and all are concerned, it will be a greenfield expansion where Saika will be involved. So it will be a little longer process.
Okay. Okay, good. Thank you.
Thanks, Shikha.
Thank you. The next question is from the line of N.K. Arora, an individual investor. Please go ahead.
Good afternoon, sir.
Good afternoon, Mr. Arora.
Good afternoon.
My question is, we are setting up a American subsidiary in US. So have we completed the setting of the subsidiary, and what will be the main benefits of this subsidiary?
So we have completed the setting up of the subsidiary, sir. The benefits is we want to have a footprint in USA. It is the largest market. We look at it positively that currently our revenue mix only 11% comes from USA, where normally most of your maximum should be coming from USA. So there's a huge ground to be covered in US. So staying there and forming relationships there and finding similar maybe partners for value-added formats like we did in Germany, contract manufacturing value-added formats, we are looking for opportunities there as well. To maybe contract manufacture value-added formats so that we are at the customer's doorstep. As in when we have more steps that are taken and put into action, we will keep everyone informed.
Thank you. Thank you so much.
Thank you, Mr. Arora.
Thank you.
Thank you. The next question is from the line of Sanchit Agrawal from Little More Investment. Please go ahead.
Thank you for the opportunity. My question is, what are the management's view on getting the company listed on NSE? As a lot of clients are interested in the company but are still holding back as the company is not listed in the NSE. So, like, by when should we expect the company to get listed on the NSE?
We just last maybe September, I think September or October or last year November, we finished our merger process with Fermenta, and unfortunately this COVID hit. Otherwise, our plans were to start the process and approach and see what are the steps we need to take to get listed. So I can't give you any timelines before we engage and start on that path, but we will keep you informed. We are our intention is to seek listing in NSE as well. So as and when we understand a little better on the requirements and our eligibility and everything else, we'll keep everyone.
All right. Thank you.
Thank you, Sanjay.
Thank you. The next question is from the line of Jayant Shah from JS and Associates. Please go ahead.
Yeah. Thanks to all of you for giving me this opportunity. I am Jayant Shah, an individual investor. Just my question is not from commercial point of view. It is only from the point of view of religion, because in your presentation you mentioned that you are obtaining cholesterol from the fish oil. So I would just like to know whether any of your raw material or finished products are used, are obtained after killing or inspecting or doing any research on the living animals or the insects or anyone. Can you clarify this?
Sure. As far as vitamin D3 or any other product that we sell, no animal, no killing, nothing. The cholesterol, that is our key raw material, comes from sheep wool, but this is live sheep where the wool is taken out and the sheep grows back the wool. Then the wool is brought to the textile industry and all. When that is processed, we get wool grease and cholesterol from there. So there is no killing of any animals, Mr. Jayant Shah. As far as cholesterol from fish oil is concerned, this is after people use this fish oil to take out omega fatty acids, right from EPA, DHA and all. This is one of the sources. Other one is algal source. So after they take it out, we are value adding to that by taking out this cholesterol. However, this cholesterol that we take from fish oil is being sold for the shrimp and aquaculture industry. It is not being used for any other API of ours currently or being sold in the human form in D3 anywhere. No, sir.
Okay. How many percentage would be would be using for this?
Pardon?
In terms of percentage, how many percentage you would be using?
Where? What percentage of?
Roughly percentage of your total raw material?
But that's what Mr. Sumesh Gandhi was mentioning earlier. Or
roughly, I want just rough estimate.
45% of our raw material procurement is cholesterol, sir.
Okay. And how many from this fish oil?
Fish oil is just started. This is not in the 45% we are talking about. It's a separate revenue stream and a separate product stream. Currently, we just started manufacturing this product and the sales. Maybe by the end of the year, we will be able to give it in percentage terms. Otherwise, it will be less than 1% because just last quarter or something like that, we started the sales of this fish oil product, cholesterol.
Yeah. Okay. Yes. Thank you very much for your adequate clarification, sir. Thank you.
Thank you, Mr. Shah.
Thank you. The next question is from the line of Utkarsh Somaya, an individual investor. Please go ahead.
Thank you for the opportunity. Could you please tell me what kind of revenue you can do at 100% capacity utilization in each of your products? Satish, would you want to take that?
Yes. As far as the human vitamin D3 is concerned, unfortunately, we are until our next expansion phase, which is coming up the end of the next quarter, comes into place, we are close to complete capacity utilization. Close to. As far as animal feed is concerned, we have much more scope. We are still not at complete capacity utilization. But to tell you about a figure in terms of what revenue it would bring will all depend on the prices that are there prevalent. As you all understand that the animal feed prices have been quite fluctuating. It is not just a recent phenomenon. It has been there for quite some time. Over the last 10 years also, the fluctuation, we are putting it in our investor relationship investor presentation charts and all that. So the fluctuation is there, so it will be difficult to plug a number. But in terms of volumes, I think we will be capable of going up by another 60 to 70% or more once our new product gets approved by more customers. We have capacities to take it up by another 60-70% in terms of volumes.
Okay. So even at a depressed price, worst case scenario, we can at least do 50% higher revenue than we are doing currently in animal?
Animal currently, actually nice that you have asked that question. Animal currently, I think it's at the rock bottom, both at prices and volumes.
Okay.
So it should only be better. But COVID has not really helped. The entire organized industry, if you'll understand, the entire organized industry on consumption is completely gone down. Restaurants, hotels, banquets, weddings, airline industry, where all the consumption is maximum. It's all gone down because of this COVID. So as and when things come back, I think we will start seeing that growth. Human anyway is growing. All of you know how important vitamin D is. Everyone is talking about it. So that growth is here to stay, and it should still grow. We're just waiting for the animal things to pick up so that both combined together can give us a boost.
Okay. So when you say we can do 60 to 70% more volume, that means we're currently operating at 30-40%. Is that the correct understanding?
On the animal side?
Animal? Yes, animal.
Yeah, this quarter maybe, yes.
And we should take about 12 to 18 months to reach 100%? I mean, given other sectors will recover by then?
If everything else recovers by then, maybe 12 to 18 months maximum, yeah.
Okay. And just one more question. After your expansion in human healthcare, what can be the revenue?
About 25 to 30% minimum increase should be there in our overall capacities.
And that will commission next in Q3, right?
No. The plant should be ready in Q4.
Okay.
By the end of Q4, we should be able to start producing, hopefully.
And given the demand, do you expect that will get utilized immediately, or do you expect some lag time?
Our expectations are that it should get utilized immediately.
Okay, sir. Thank you so much. And good luck.
Thank you.
Thank you. The next question is from the line of Nirav Shah from Exemplar. Please go ahead.
Yeah, thanks for the opportunity. I wanted to know what was the average price of human D3 in Q2?
We cannot give an exact number due to competitive reasons.
No, I'm not talking about your realization. I'm talking about general market.
General market varies on the human side is between $2,000 to $3,000 will be the range that it will be varying depending on the customer and volume requirement, etc. and everything. On the animal side, it is still at the $17 to $20 range. It is maintained in the last quarter as well, even today as we speak.
Okay, and assuming the steady state such pricing of animal D3 at around $18-20 and this human D3 at around $2,000. So what is basically the margin difference that company achieves in both the segments?
If it is at $20 and this is at $2,000, I think margins should be more or less similar.
Similar?
Yeah.
Okay, so if animal pricing goes up, then that will be a bonus for company. Okay, yeah. Got it. And what has been the status of our Saika plant and by when we see that plant up and running?
The Saika, we have not even started. It's a greenfield project. So currently it's in the planning stage to what all we can accommodate, which all products we can accommodate. I think our plans will be finalized by the end of this quarter. And then maybe Q4 or next year, Q1 onwards, we should start the actual
so by Q4
on ground activity.
So by Q4 FY22, it should get ready?
Should. Q4 FY22 or Q1 FY23, we should have our first phase ready and material coming out of there.
Okay, so till then, our Dahej and Kulu plants which are there, that you see sufficient to keep our growth plans intact?
Yes. In fact, as I mentioned earlier, by this Q4 itself, we will have our expansion coming up and one more product coming up, vitamin coming up. So I think we should be good.
What my next question was regarding that only. What kind of opportunities you see in that vitamin K1 business?
It's a niche market, very few players. It is something like vitamin D, which we understand very well, both in terms of handling a delicate vitamin as well as the presence in a niche vitamin where very few players are there. I think the opportunities are good for us. Very few players are there in the market. It's a niche market again. It is not a like a vitamin A or a vitamin A that's such a large segment. So vitamin K1 is a niche market. We should be able to have our role there.
Your target for that product is domestic only or basically export?
It's both. We are present in almost 50 countries currently, so we will go everywhere with it.
And that product will be we will be starting from next quarter, right?
Q4 onwards, the plant will be ready. Of course, it will take it's a new plant, new product. So, and this is a human pharma and dietary nutrition supplement industry. So the regulatory and the customer approvals will take their time. So I won't say that it sales will start the next day, but production will start most probably by Q1 of next year.
Okay,
we should be able to launch the product by Q1 at least.
Okay. Thank you very much and all the best for all your future plans.
Thank you so much.
Thank you.
Thank you. The next question is from the line of Shikhar Mundra, an individual investor. Please go ahead.
Hi, good morning. So most of my questions have been answered. Just wanted to know about this 150-200 crore capex we are doing for the new products. So, can you give a color on the new products? Like, what are those like, and what's the opportunity size in those products?
See, to start with, we are looking at minerals like, for example, ferrous, that is iron-based salts and calcium-based salts. For that itself, the market should be, only in India itself, it should be close to about 100 crores odd.
Okay.
Only in India. Currently, we expect the market to expand dramatically because the government is looking at fortifying rice with iron along with folic acid and B12. So the market will expand significantly once that happens. So these are the salts, iron salts we are looking at, and some more calcium salts we are looking at. Then we are looking at a premixing plant where I think the current market size itself should be close to about 200 odd crores. Just within the fortification of let's say milk and oil we are talking about. Otherwise, the market size is much larger. And again, government, once it talks about the premixing business in milk compulsory and rice, fortified rice, they are making mandatory in the public distribution systems. So there itself, the premix opportunity could be as big as 700-800 crores only in the rice part of it, only in India, that too. Okay. So the market opportunity is large. So it depends on our market share and along with the market how we can grow.
All right. So right now, majority of these products, are they being imported or are they being manufactured in India? What's the competitive scenario?
As far as the iron salts are there are a few companies in India, and there are imports as well. As far as vitamins are concerned, I think especially the ones that are getting fortified and all, a large portion of the ingredients at least get imported. And premixing happens in India by both multinationals as well as Indian companies. But there are hardly 4 or 5 companies, both multinationals and Indian companies put together. There are hardly 4 or 5 companies in this space. So, and India especially, it is a nascent stage where the market is set to expand. So I think there is room for more players, and especially players like Fermenta, where we have demonstrated our capabilities. We should be able to make a play role in this.
Okay. And what would you expect, like the typical margin profile? So these must be like niche products, I believe. So
Yes, it depends. If you're putting in your own ingredients, the margins could be higher, as high as maybe at COGS level should be as high as 40% or 50% or higher. But if you're buying some of the materials, it could go as low as 20-25%, but we are not looking at less than that.
Got it. And for this quarter, I believe the ratio was 69-31 for human to animal feed and revenues. So, was the margin profile also similar?
Sumesh?
Margin profile was similar, not similar. Margin profile was more or less similar in both of it as far as the EBITDA is concerned.
Okay. So when the animal feed prices are depressed at $18-20, the margin profile is being similar in human to animal feed. Is my understanding correct?
Yes, that's what
at $2,000, if you are assuming a price for vitamin D3 human, and if you're assuming an $18 to $20 on the animal side, margin should be similar.
All right. And the human feed prices are more or less, they are not so volatile. But is that also correct?
Yes.
Okay. So like we can expect a big upside from the animal feed prices when they correct. So because the human feed prices will more or less stay constant. And
you're right.
Okay. Got it. Okay, thank you. That's it from my side.
Thank you, Shikhar.
Thank you. The next question is from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah, good evening, sir. Good afternoon, sir. My question relates to two things. One is the D3 prices which is corrected in this current quarter. How is the trend now, and what was the reason for this decline?
You are talking about the animal feed, Sunil?
Yeah, animal feed.
I think it's a combination of the demand going down, which will definitely put pressure on the volumes and capacities that everyone has. I think significantly that has played a role in the prices going down. So these prices have come down, and they went up almost to the high levels of 60 in Q1.
Yeah.
But by maybe end of Q1 itself, they started coming down to that 18-20, and they have since then stayed at that levels.
So, as such, there was no specific reason. Only thing is
demand.
Demand. Any specific reason for demand to come down, or that was?
Yes, the entire animal feed. This goes into the entire meat industry. That is the ruminants, the cows, the pigs, and the chicken. That industry itself is down. During this COVID, as I was earlier mentioning, the entire organized sector of hospitality is more or less down, right from hotels, restaurants, casual out eating, to imagine the travel that used to happen world over in the airlines and how much consumption and wastage would be there. So the entire industry itself is just more or less no one is moving anywhere. And how many times you would like to go through the process of making steaks at your house every day. So I think that has been the most significant impact on this industry.
Okay, fine. And these prices are still low.
And they're still at about 18-20. Prices is one thing. There is volume is the more important part of it. It's quite suppressed.
And this quarter we had a higher interest cost. Is there any one-off in that, or this has got the impact of this expansion which we had done?
Yeah. So you're right over there, Mr. Jain. It is because of the expansion which has come in, and we used to capitalize the interest also earlier. But there are two things. One is my cholesterol project is now ready, so the interest gets into revenue expenditure. Plus the capex which we have undertaken right now. That's another reason why the interest cost is so high.
Okay. So for full quarter the interest has come, or for part of the quarter?
Most of the quarter.
I mean to say this interest will continue as it is in the coming quarter.
Should
Sure.
Or will it increase further from here?
I don't think it should increase.
Okay. And about the working capital, we have seen some improvement in this quarter. How's the trend now? Means is this likely to further improve, or how we had come to a good level? But good improvement is seen from March to now.
Are we talking about the working capital
cycle?
Working capital cycle. So it has to improve going forward because it's still being at a little bit higher side because of the inventory build-up which we have taken for a strategic reason. So going forward, it should improve from here.
Okay. So inventory you expect further to normalize?
Right, sir.
Okay. Great. Thank you very much.
Thank you, sir.
Thank you. The next question is from the line of Rusmik Oza from Kotak Securities Limited. Please go ahead.
Good morning, sir. Thanks for the question. I had two questions. One was on the backward integration. As someone asked earlier, and you mentioned, that you would get a benefit of around 20-25% on the 45% raw material cost of cholesterol. That could take your margins to EBITDA margins to around 35%. But when can we get the benefit of this 35 and increased EBITDA margins from Q3, Q4, or it will start from next fiscal year?
I must maybe not correct, but I must maybe just clarify that point. We were not talking about 35% EBITDA margins. What we said was 45% of our raw material purchases was cholesterol. Based on that, the gentleman had assumed that your raw material cost of cholesterol will come down to 35% of your overall purchases.
Okay.
It will not directly impact our EBITDA by that much margin. So I think there must be some misunderstanding on that.
Okay. And sir, second question was on that 150-200 crores greenfield expansion that we are aiming to do.
Yes.
Maybe after 2-3 years, what could be the sales to gross block ratio or sales to gross asset ratio that we can assume coming from this project?
See, overall, we would assume that we should be able to maintain the 20 to 25% EBITDA margins going forward. And maybe in the next 4 to 5 years, the revenue stream from the existing business and the new business in the next 5 years or 6 years should be close to maybe the current business, maybe 50-50 or something like that, or the current business slightly more. That's it. But otherwise, overall, we expect to maintain the 20-25% margins in our overall revenue earnings.
Okay. Thank you. That's it from my side.
Thank you, Mr. Oja.
Thank you. The next question is from the line of Viraj Mahadevia, an individual investor. Please go ahead.
Hi, Mr. Verma. Sorry, just a reclarification.
Sure.
Again, on the margin point. So you mentioned that of the raw material cost, 45% is cholesterol, and on that we would have a 20 to 25% saving. So if I run the numbers, it means that backward integration, my EBITDA margins could go as high as 32 to 33%. Maybe not 35, because I think there was slight misunderstanding there. And also, your past cycle margins in FY19 for the full year was 35%. So do you see yourself getting closer to the 33 to 35% EBITDA margins over maybe next financial year, FY22?
It will depend on the animal feed prices, how they would support the overall mix. It will, because it is not a small portion of our overall business. If you look at FY19, if you're referring to, I think the animal feed business contributed more than 56 or 57% in FY19 for the numbers.
Prices were high.
Prices were high. So I think it depends on how the prices will be there. Volumes, we are sure we will be able to match and maintain or increase our volumes contribution. But on the prices, I think it will depend on where the prices are at that time.
Understood. And are you seeing a trend upwards in prices in animal feed after these quarterly results? I mean, generally, what is your sense in the last month or so? Because, for example, in China, I've seen that the pig herds have increased massively in the month of August.
Yes.
Over the month of August and September. So hopefully that should lead to an increase in demand for animal D3.
Hopefully, but we have still not seen it on the ground, Viraj. We have still not yet seen. As we speak today, we have still not seen it at the ground. It is still being maintained at the same levels.
Right. And my last question is on the vitamin K that you're coming on stream later this financial year. Will that be sold to a same set of customers? I.e., are customers already asking for this product and it's a function of having this product ready and selling it to them, so it's an easy sale? Or is it a completely different set of customers and you have to build that over time?
No, it is the same set of customers. Actually, we developed the technology on request of one of our largest customers, actually.
Understood. Okay, perfect. Thank you. That's it from me.
Thank you, Viraj.
Thank you, Viraj.
Thank you. We take the last question for Utkarsh Somaya, an individual investor. Please go ahead.
My question has been answered. Thank you.
Thank you.
Thank you.